Welcome to the Deep Dive, where we cut through the noise of complex reports and earnings calls to give you the real story.
That's right.
Today, we're diving into Tourmaline's Q2 2025 results. And let me tell you, there's a really fascinating puzzle here at the heart of this Canadian energy giant's performance.
Definitely is.
Our mission, as always, is to unpack what truly matters to you. So let's get right into it.
Let's do it. What's really interesting here is that immediate tension, right in Tourmaline's Q2 results. On one hand, you've got incredible efficiency, but on the other, a revenue miss that really seemed to grab the market's attention.
Absolutely. Let's hit the headlines first, because right off the bat, you see this kind of dynamic playing out.
Yeah.
Tourmaline delivered a massive earnings per share beat in Q2, GAAP EPS of $1.35. The consensus was just $2.97.
Wow.
That's a 38% beat. So way ahead on the bottom line. Sounds like a home run, right?
It really does on the surface. But here's the flip side, the other part of that coin.
Right.
Despite that really strong EPS beat, the company's revenue came in at $1.51 billion. That actually missed the $1.65 billion consensus by about 8.5%. And this happened even though they saw, decent 6.7% year-over-year growth from Q2 last year.
So that revenue miss, especially sitting next to that big EPS beat, yeah, that immediately raises questions for investors.
It creates that immediate puzzle.
It really did. And beyond earnings and revenue, their cash flow looks solid. They reported $822.8 million in cash flow. With over $116 million in free cash flow. Yeah, that's the money left over after all their capital spending. Super crucial health metric.
Absolutely key.
Net income landed at $514.6 million. Operationally, production was robust too, hit over 620,000 barrels of oil equivalent per day.
BOE'd, yeah.
That's a solid 10% year-over-year increase, and their realized gas price, strong. $3.34 per MMcf.
And that was way above benchmark.
Yeah, an impressive 94% above the AECO benchmark. That's the key gas price hub for Western Canada.
Right. Yet, despite all these strong operational numbers, strong profit figures, the market reacted, pretty negatively. Investor sentiment turned noticeably sour, within about 30 minutes of the call start.
Really? That fast?
Yeah, it led to a significant slide in the share price, and it was accompanied by unusually high trading volume. Big selling pressure.
Okay, so that tells you a lot about what the market chose to focus on, at least in the short term.
It does. The impressive operational performance, the EPS beat, they seem to get overlooked. People focused on the revenue miss and maybe broader concerns.
So what does this all mean, this immediate disconnect, right? Strong earnings, revenue miss, market sell-off. It's a real head-scratcher.
It is.
Expert, what did management actually say about this? And what are their long-term plans that maybe are getting lost in the noise here? Did CEO Mike Rose's commentary give you any clues?
Absolutely. Rose's confidence really came through, I thought, especially about their asset base. He emphasized the company's long-term free cash flow durability. He actually said Tourmaline can continue to produce at these levels and generate annual free cash flow of this magnitude for literally decades.
Wow, decades. That's a bold statement.
It is. It speaks to their belief in the longevity of their reserves, and it's worth noting their Q2 production, that's 620,000 plus BOE per day, right at the midpoint of their guidance.
Even with disruptions.
Yeah, even with challenges like wildfire-related shut-ins and some periodic shut-ins up in Northeast BC because of low commodity prices. So that shows some operational resilience. And they're keeping a very strong balance sheet. Net debt is only about 0.5 times their 2025 forecast cash flow. Very low leverage.
That's a strong foundation. But the real long-term story, the part that probably deserves more attention from investors, that's in their strategic growth initiatives, right?
Exactly.
What are these long-term plays? How significant are they, especially around LNG?
Yeah, this is where it gets really interesting, I think. A huge highlight was this new 8-year LNG feed gas supply agreement they signed.
Okay.
With Uniper for 80,000 millimilla-2 per day. It starts November 2028.
8 years. That's a solid term.
It is. And the deal includes firm U.S. Gulf transport they secured with TC Energy, starting even earlier, November 2025.
So they get pipe access soon.
Exactly. This means Tourmaline gets direct access to European natural gas markets. plus flexibility for short-term sales even before that Uniper contract kicks in.
Okay, that's a big deal. Diversification, premium pricing potential.
It's a material step, yeah.
Yeah.
Moving away from just being exposed to local Canadian prices.
That Uniper deal and the Gulf transport sounds like a massive play. But that wasn't all, was it? They also unveiled an updated multi-year development plan for Northeast BC Montney.
Indeed. And this plan is ambitious. They're targeting a production ramp to 850,000 barrels of oil equivalent per day.
850K.
Wow. By the early 2030s, that's a huge 30% increase from where they are now, their current average.
How are they paying for this?
That's the key. Yeah. This massive build-out, they project it'll be fully funded by cash flow, which is crude oil, obviously.
Right. No massive debt increase.
Hopefully not.
Yeah.
And once production matures and capital spending kind of normalizes back to just maintenance levels, this plan is expected to generate a staggering $2.5 to $3.0 billion in annual free cash flow.
$2.5 to $3 billion a year.
Yeah, and that's assuming flat prices, U.S. $65 WTI oil, and U.S. $4 NYMEX gas.
Okay, so they're not just growing production volume, they're aiming for a step change in free cash flow generation, self-funding a huge expansion. That's the dream.
Pretty much.
To get that kind of growth, they must be building a lot of new infrastructure. What are we talking about here? Like, what are they building?
Yeah, it's a considerable infrastructure build-out. Think about this. 2 new deep-cut gas plants.
Deep cut? What does that mean?
So these are specialized facilities. They extract more of the valuable liquids, like condensate and NGLs, from the raw gas stream. Significantly boosts profitability compared to just selling dry gas.
Got it. More value per molecule.
Yeah. Exactly. Plus, expansions to 4 existing gas processing complexes, 3 new hydrocarbon liquid hubs, 5 water recycling facilities, that's important for sustainability, and electrification of 4 gas plants, plus new pipeline corridors.
So this isn't just about pumping more gas. It sounds heavily focused on liquids growth and improving margins.
Precisely.
Yeah.
Leveraging their position as the largest liquids producer up there in Northeast BC already.
And it sounds like they're not just talking about it, they're moving on this. When do we actually see the first results, the first production bump from this?
You're right. They seem to be moving fast. First material production from this big project is expected in Q4 2026.
Okay, so a couple of years out.
Yeah, with the Aitken C38C plant expansion. That'll be followed by the Ground Birch Deep Cut gas plant in the second half of 2027.
And are the permits and stuff in place?
They said both projects, importantly, already have the necessary permits and the long-led procurement is underway. Yeah, getting the big equipment ordered.
Good. So less risk there.
Right. The ultimate goal is adding 1.1 billion cubic feet per day of new gas production and over 50,000 barrels per day of condensate and NGLs over the next 6 years.
That's huge.
It really signals a significant pivot for the company, towards organic growth, building it themselves, and long-term shareholder returns rather than just relying on, say, acquisitions.
Speaking of shareholder returns, what about dividends, buybacks? Are they still committed to giving cash back to investors while they're in this heavy spending phase?
They absolutely are. Tourmaline declared a $1.35 special dividend, payable August 20th, record date August 8th.
Another special dividend.
Okay. Alongside reiterating their regular $50 quarterly base dividend. And they also have a freshly renewed NCIB, that's their share buyback program.
So covering all the bases.
Seems like it. Management indicated their primary focus, though, during this capital-intensive phase would be on per-share growth and the dividend yield, which makes sense, right? They're building for the future value.
Makes sense. Okay, let's shift to the operational front, the outlook. You mentioned the full year 2025 capital budget is unchanged.
Right, C2.6 to C2.85 billion.
But Q2 spending was actually C$70 million less than forecast because they deferred some activity.
Correct.
How does that impact their production guidance for the year then?
Yeah, good catch. As a result of those deferrals, their full year 2025 average production guidance was adjusted slightly downwards. Now it's between 635,000 and 650,000 BOE per day.
Okay, a small tweak.
Yeah, and it really highlights their flexibility.
Yeah.
The company specifically pointed out they can defer capital from Q3 into Q4 2025, or even push it into Q1 2026, depending on what natural gas prices are doing.
Smart.
It underscores that commitment to optimizing free cash flow rather than just blindly hitting production numbers regardless of the price environment.
That's prudent management in a volatile market. Are they anticipating any improvements in commodity prices that might help their cash flow maybe in the second half of the year?
They are. They said they anticipate higher free cash flow in the second half of 2025, driven by 1, expected commodity price improvements, and 2, the ramp up of the LNG Canada facility, which should start pulling gas out of the basin.
Ah, LNG Canada. That's the big one.
Exactly. They attributed the current weak Western Canadian gas prices largely to export restrictions and a lot of maintenance at key export points, which backed up about 1 BCF per day of gas into the basin. They expect that market sort of aberration to clear up by September.
Okay. Do they have hedges in place to protect them from low prices?
They do have a good chunk hedged. 1.1 BCF per day for the rest of 2025, hedged at $4.48 per MMBtu. That provides some cushion.
That's a decent price.
It is. But management also cautioned, and this is important, a $1 per MCF swing in AGACO prices translates to roughly $500 million in free cash flow impact.
$500 million for a $1 change? Wow, that's huge sensitivity.
Massive sensitivity to gas prices.
Any other operational highlights? Or maybe potential upsides that aren't even baked into this big plan yet?
Yeah, one thing they mentioned, maybe easy to overlook, is their new pool successes down in the Southeast Basin.
Okay.
These are apparently evolving into a significant new growth project. And the key part is it's not yet included in the current detailed development plan.
Ah, so potential future upside beyond the 850K target.
Exactly. Signals more growth potential down the road.
Yeah.
Long term, they expect the liquids mix to stay pretty consistent around 75% gas, 25% total liquids, despite any short-term fluctuations from turnarounds or drilling schedules.
And cost savings from all this new infrastructure.
They're projecting operating cost savings from the Northeast BC build-out of about $1 per BOE, split roughly 50-50 between lower operating expenses and lower transportation costs.
Nice. Every dollar helps.
Definitely. And they're also actively looking for more physical transport capacity down to the Gulf Coast in the coming years. More market access.
Okay, let's talk about the investor context now, because it's fascinating, isn't it?
It really is.
That immediate market sell-off after the call, it clearly shows investors focusing on that revenue miss and the ongoing macro gas risk.
Right. Absolutely. Seemed to completely overshadow the strong EPS beat and, maybe more importantly, those huge long-term strategic announcements, like the Uniper deal, the massive Northeast BC Montney plan.
Yeah, it's almost like the market sometimes has blinders on,
Yep.
focusing only on what's right in front of its nose, not the horizon.
That short-term myopia, it was certainly evident here. And the sell-side analysts. Kind of a mixed reaction, which isn't surprising given that dichotomy.
What did they say?
Well, you had UBS staying neutral, but cutting their price target down to $67. TPH reiterated their buy rating at $77. But Raymond James actually downgraded to market perform.
So all over the map.
Pretty much. Management's tone on the call was described as moderately bullish, emphasizing that free cash flow durability despite the near-term headwinds. But like we saw, the market's focus was just elsewhere that day.
And the stock performance tells a similar story, right? Tourmaline stock lagged its Canadian energy ETF peers, like the XEG.
Yeah, the XEG, that's the iShares S&P TSX Capped Energy Index ETF, a good benchmark for the sector.
So Tourmaline lagged that over the 1 month and 3 month periods after the call.
Correct. Despite actually outperforming on a 1-year basis.
Yeah.
So it suggests a recent cooling of investor interest.
And didn't you say there was a rally before the call?
Yeah, that's also important context. There was a press release on July 30th before the earnings call that detailed the Uniper deal, the refreshed development plan, the special dividend.
Okay.
And that had actually driven the stock up to an intraday high of $63.19. But that rally was pretty much completely unwound during the earnings call itself.
Wow. That is telling. So looking forward, what are the key things to watch? The catalysts.
Okay, key catalysts. LNG Canada startup, that's Q4 2025. That should help tighten up regional gas markets.
Big one.
Then the Phase 1 Aitken expansion, that's Q4 2026.
Yeah.
First major piece of their big growth plan comes online.
Okay.
And then longer term, but very significant, the Uniper contract starting in 2028.
Right. And management had that analogy. Yeah. Something about a spring.
Yeah, they made an interesting comment. Said the current export restrictions are effectively coiling the spring for a much tighter gas market in 2026.
Oh, so?
Because storage capacity in key export markets, Pacific Northwest, California, Chicago, is getting drained while these restrictions are on. So when things normalize, the demand pool could be really strong.
Coiling the spring. I like that.
Yeah.
Okay, let's put on our imaginary hedge fund analyst hats for a minute.
All right. The fun part.
This is our not financial advice segment, obviously, but it's a way to think about how all these pieces might fit together into a potential trade.
Right.
We've seen the market punish Tourmaline, right? For the revenue miss, the current gas price weakness. Despite the monster EPS beat, despite this long-term strategy that could mean decades of huge free cash flow, That creates a really interesting divergence.
It really does. The market seems totally fixated on today's low AECO prices, the revenue miss. But Tourmaline's playing a long game here.
Exactly. Executing a multi-year plan, locking in export options, building infrastructure, stuff that should significantly boost margins in FCF by the early 2030s.
Right.
And critically, LNG Canada starting Q4 2025.
Right.
That's a real near-term catalyst for AECO prices.
It should be.
So here's an idea, maybe a bit out there. A long TOU, short near-term AECO, long-dated call option overlay strategy.
Okay, break that down. Long TOU.
Right. First leg. Take a significant long position in Tourmaline common share. You're betting on the underlying value of their assets, the growth to 850,000 BOE'd, that C2.5 to C3.0 billion dollars annual FCF potential if prices cooperate. The core long-term story.
Makes sense. And the short AECO part. That sounds counterintuitive.
It does, right. But the idea is to hedge against that lingering near-term regional gas price weakness. The stuff management themselves acknowledge why they're deferring capital.
Okay.
So you'd layer in a tactical short position in AECO natural gas futures, specifically targeting contracts maybe expiring in Q4 2025.
So betting prices stay weak for a bit longer.
Yeah, basically trying to capitalize on any continued temporary pressure from maintenance or oversupply while protecting your main long equity position. It's a hedge against the market's current fixation. It is the outrageous part for some, shorting the commodity of the company you're long.
A calculated hedge.
Oh,
Okay. And the third leg, the call options.
Simultaneously, you'd buy out-of-the-money, long-dated call options on TOU itself, maybe looking out to late 2026 or early 2027 expiry.
Why the options?
It gives you asymmetric upside leverage, a cheaper way to capture the full potential impact when things really start clicking, like the Aitken plant expansion in Q4 26, the Uniper contract getting closer, the whole FCF profile shifting as the NEBC build-out progresses.
So low-cost participation in the big payoff later on.
Exactly, without tying up tons of capital up front. So the whole strategy, it acknowledges the current headwinds, that's the short AECO. But it expresses strong conviction in Tourmaline's execution and long-term value. That's the long equity plus the long calls.
You're basically betting the market's myopia is temporary, that eventually you'll recognize the strength and earnings power of this low-cost LNG-levered gas champion, as you might call it.
Precisely. So wrapping up, what we've seen from Tourmaline's Q2 call is this really fascinating blend, isn't it? Immediate market pressures versus these incredibly ambitious long-term strategic plays.
Totally. Investors reacted to the revenue miss, the macro gas risk right now, but management clearly focused on building a resilient, high FCF generating company for, as they said, literally decades.
Understanding these nuances, this disconnect between short-term sentiment and long-term strategy, it's just crucial for navigating today's complex markets, I think.
Absolutely. It's where opportunities can emerge, but it often demands patience, that longer-term view.
As always, remember, this deep dive is purely for informational purposes, definitely not financial advice.
Please don't trade based just on this.
We hope this gave you a clearer picture of the whole Tourmaline story, though. What stood out to you from this deep dive? We genuinely love hearing your thoughts.
Let us know.
Until next time, stay well informed.